Private equity, VC, growth equity, people love to throw the terminology around, especially in front of the creative folks like yourself, to ensure that, you maybe need them a little bit more through the process of potentially raising investment for your company. Well, I'm here to show you that it's actually a lot simpler than what people may try to make it seem, primarily because a lot of people with very base level skills are actually in those careers, to be honest. So there's not too much of a complication there. And I'd rather, through this video, help you understand not only the categories of the investments you can pursue, but also the kind of investors you're going to face and what kind of things you should be aware when it comes to talking to them. And we're going to do all of this through a very simple visual. Before we go through all of this, I do want to make sure we first start with actually talking about the kind of investors you're going to face. And I'm keeping it kind of like down to these five because those are the five most common ones you'll come across. And I'll mention a few other kind of like honorable mentions as we talk through it. First and foremost, when it comes to thinking about seeking an investment for your business, especially as a creator who potentially has an idea in terms of how you can expand your revenue potential beyond just AdSense brand deals and maybe some membership like YouTube memberships, or maybe you have a Patreon page. Friends and family is a good way for you to potentially fund a business idea. All that really means is exactly kind of like, what's on the tin? You get to talk to your friends and your family and ask them for potential investment in your business. As simple as that. This is usually recommended for early stages that we're going to talk about in a second. And primarily the reason why you want to go with that route is there's all this obligation. You obviously will feel the pressure, especially if it's someone who is close to you, who is potentially co-investing in your business. You would want to make sure you don't lose them their money. But from the perspective of legalities, potential, complexities in terms of corporation structures and things of that nature, especially early on where you're just investigating the idea. Friends and family cutting you a few $1,000s here and there to help you co-invest into the brand and you offering them equity in return in that business is a good first step. So this is all that it means. You essentially go, and how you structure it, what are the agreement, do you sign any paperwork? It's really between you and them. In some cases, it's a good idea, in my opinion, to have at least some sort of an outline of like what actually are they getting in return. In some cases, they might not even ask you, and I guess it's okay, but in case things go really well or really badly, I think you want to make sure you have some paperwork to rely on. So I would probably even sign it, even if you want to just chat GPT it, although not recommended from legal perspective, but you can find some templates out there that you can freely use, or just ping me and we can do it together. Now, from the friends and family, you go into the angel investment stage. And from their perspective, angel investors are essentially, again, kind of what's on the tin is what's inside the tin, is that those are usually more high net worth individual. Not to say that your friends and family cannot be high net worth, but those individuals usually have a lot more funds, and again, they pursue a much simpler structure when it comes to the investment into the businesses. They like to do it early on. They like to offer a check, and sometimes it can be a few $1,000s, sometimes it can be $100,000 plus, where they just believe in the idea, they believe in the founder, and they go and they invest. Angels usually someone you find through your network, right? So as you kind of like go kind of like about your life, as you develop your creator brand, as you start thinking about this idea, you'll probably meet a few folks who will introduce yourself, and they'll introduce themselves to you, and they will tell you that, hey, yeah, I do some angel investing here and there. Those individuals I would keep in mind for this kind of engagement, because in their case, they're used to not necessarily having too many ties, or not necessarily having too many complexities around what kind of thing they're investing in. They like to support founders in the earliest stages, and those are the individuals, kind of like, that's why you call them angels, because they're not really trying to overcomplicate your life. You're still early on in the development of your business. They're just trying to support you. And big distinction, your angels can be your friends and family, but usually you would find sometimes individuals who are the third party. You might have never met them before, but someone introduced you guys, or you met them before in some other occasion, and they just like the potential idea that you bring to the table, so they'll go and they'll co-invest with you. Now you're getting to the fun part, the venture capital and private equity. I'm kind of like, I'll talk about them back to back, primarily because technically venture capital is private equity. So it might sound confusing, but in general, private equity is yet another one. Again, you see, that's the thing. People like to overcomplicate it, but the idea is that it's just private capital. Whenever someone invests their private capital into the entity, that's a private equity. They take the equity from the bank account, they convert it basically into cash, they give it over to you, and they take the equity in your company. That's why it's called private equity, right? There's no like public accounting involved. There's no, IPO and things of that nature that is being kind of like considered. It's just an individual who has the money and they come and they invest in you. Venture capital kind of like became sub-segment of private equity, and private equity itself became kind of like a bigger beast. So that's why we kind of like split them these days. But just in general, know that they're both part of the same. And the main differentiation is that venture capital is the earliest stage investment. So those are usually individuals who are a lot less involved in the operations of your day-to-day business. They are, like a better word, a person who likes to place multiple bets across different businesses that they're very familiar with and the industries that they're familiar with. And their goal is not to hit it out of the ballpark with every single investment. So VCs usually operate earlier stage companies. They like to invest, as I said, in multiple bets, and hopefully 1 out of every 10, out of every 50 really strikes it and becomes that next Uber, that next Facebook, whatever the other company might be. And all the other either get consumed by some other company or just fail, right? And they understand it. It's a high stakes game. They understand that they're risking a lot when it comes to co-investing in some of these businesses. And so those individuals usually manage a portfolio of different bets that they placed. And that's where you can see some larger venture capital companies who are very experienced, like Sequoias of the world, Y Incubators of the world, Anderson Horowitz, right? A16Z, basically, they have thousands of bets out there. And those bets can range in tens of thousands of dollars, hundreds of thousands of dollars, or millions of dollars. And similarly, kind of like if you go from there on and you say, okay, but then what's the difference between venture capital and private equity? Private equity is really, they're playing further up the market with more mature companies. They get a little bit more involved in the operations of the business. Usually, if venture capital is some venture capitalist is someone who just like places a bet, they give you the funds, and they're there as your advisor, as your board member. They're not with you day to day. Private equity will very likely would want to be at least close enough for you, close enough to your team that they understand what's happening day to day. They might not be there always managing, although many private equity companies, when they buy out the companies, they like to hire someone who they're familiar with as an operator for the business, or suggest certain team members as operators for certain parts of the business. They're getting a lot more involved, but usually because they take a much bigger stake in the company. Venture capital, they'll give you the check, they'll probably take 10-20% of your business, but it's not necessarily going to be full majority. Private equity, sometimes they're just interested in taking a smaller portion of the business. Sometimes it's just what you negotiate, but in some cases, private equity actually wants to take over the full business and fully outright purchase it so that they can make the call on what's going to happen in that business, and then they decide how to exit it. So this is where kind of like the distinction is. Although both of them technically private equity, it makes sense to split those two because venture capital usually operates early stage with early stage companies, where private equity companies, like in the classic definition, they operate further with more mature companies, and also how they bring in the cash can differ a little bit. Where venture capital usually like to use their own cash that they raise in the fund, private equity use portion of their cash, but they also leverage a lot of the debt financing, and they create kind of like those like leverage positions where they go and combine multiple different sources of cash to invest in a particular company. So that's kind of like more complexity in structure, more legal stuff. Traditionally, as you get involved with more sophisticated, more mature investment companies, you will see more complexity from legal perspective. You'll see more complexity from the financial structure of the company. And then finally, I should probably share it to show you the corporate and strategic and some of the other subtypes I'll mention in a second. They're more kind of like one-off scenarios. You may face them, you may not. The first four that I mentioned pretty much cover probably 90% of your scenarios that you're going to face as a creator. You're either going to raise funds from the friends and family, you're either going to raise funds with an angel investor, or you're going to hopefully go work with some of the venture capitalist companies, and eventually as your company mature, you'll attract the attention of private equity. Corporate strategic investors can come somewhere between that venture capital and private equity. Primarily, some of the larger corporations like Googles of the world and Nvidias of the world, they have their own venture capital kind of like funds that they manage internally, and they essentially set in the budget and they allocate like, hey, we made enough cash. Let's allocate $100 million for the next few years and invest in some of the companies that are complementary to our products and services with the potential to acquire them in the future. also allows them to control some of the potential, ankle biters. If you're a company who might have a competitive solution for them in the future, that's the way to keep like tabs on you. Instead of paying you $1 billion later down the line when you became a major competitor, they can invest in you a few $1 million early on, but then they kind of like co-control the company. They keep an eye on you, and they'll monitor kind of like your evolution and eventually help you decide what's the future of your company is. A good example can be Microsoft and OpenAI. Microsoft owns a big chunk of OpenAI, and although OpenAI kind of like functions as an independent company, Satya Nadella is the CEO of Microsoft. He's keeping an eye out on this company, and he understands that in the future it could be a major complementary service to their business, or it could be a potential competitor. But now that they own a huge chunk of the company, they'll benefit either way. So corporates come in those kind of like flavors. They like to co-invest in companies. It's an interesting opportunity. It usually depends on case by case and the kind of company you take an investment on. There are companies like call themselves growth equity. They're kind of like in between regular private equity and venture capital. They're really there to kind of like help you pump cash in your organization to help you grow. And they might try to structure it as an equity capital. They might structure it as a debt capital. They might structure it as a convertible debt, where at some point maybe debt is converted into equity depending on certain circumstances. Like, don't worry about it right now, because if you're at that complexity, you will have a very proper accounting and finance team working with you who will be able to kind of like give you all pros and cons. As a creator, if you're just exploring where you're going with your business idea and what kind of investors you're going to pursue, at best you'll probably be at the venture capital level. We'll talk about in a second different levels, but private equity, growth equity, corporate investment, like those may pop up, but really heavily depends on your niche and the size of business that you create. With that, let's now go and talk specifically about what the heck are you going to do depending on the stage that you're in. And I know this is kind of like, a lot going on in this visual, but the structure is very simple. You essentially, your columns are different criteria that you're going to face or stage that we're talking about. So we're going to talk about them in a second. And each row is essentially the stage of your company as an investment company, as a company that's seeking an investment. So let's just jump straight in. It will make sense when we go through the first row, and I won't have to explain as much as we go down the list. So pre-seed, you'll hear a lot this definition of the pre-seed company. Think of it very early stage, usually an idea. Maybe you have an entity, you might not even have a legal entity yet. You just have a product idea. And that's where, like, when it comes to revenue requirements and revenue, I here use kind of like US dollar, and we're talking about ARR, annual recurring revenue. The whole reason I'm using annual recurring revenue because majority of these investors, a lot of companies that's going to be evaluating your business, they really want to understand how likely that revenue to come back every year. That's where like they love their SaaS companies. They love the companies that have some sort of like maintenance services around them. Product companies, goods like physical goods, digital goods, they can be interesting potential companies. And that's where you'll probably talk more about the revenue, which is your standard definition. ARR is kind of like a more sophisticated way of talking about it because you imply that there's some sort of renewal aspect to it. And this is why I'm using throughout the rest of it, and when especially talking about go-to-market about the renewals. But if you're trying to sell a physical product, that's absolutely fine. You'll just be dealing with the revenue instead of ARR. Numbers will not change much because technically your annual recurring revenue of, $1 million a year also should equal your revenue. There's some accounting reasons why it might not, but usually they equal each other, and it's just more sophisticated term. And for some companies, they like to use it, and it's not even like GAAP defined. So it's not like accounting defined term. Revenue is really what it all boils down to. But you'll hear people throw around things like ARR, MRR, which is monthly recurring revenue, which is your ARR divided by 12, pretty much. And then you will hear on occasion like bookings, right? And again, it's more comes back to like SaaS companies. They love bookings as a metric of the future revenue that might come in. Forget about all of this right now. Just think about the revenue for the time being, but ARR is a popular one, so that's why I decided to stick with it. And when it comes to pre-seed, no one expects you to have any money, no revenue. You're early on, you're still figuring it out. From the perspective of the product, that's what I mean. It's like you just have a prototype, you have an idea. If, say, it's a service, and you want to come up with some sort of cool application for a very specific problem that you observed in the market as a creator, you spoke about that for a while, you made a bunch of videos about it, and you realize like, hey, I can actually come up and I can solve it. Maybe your early prototype is just an Excel spreadsheet and you have it there, or maybe it's some demo that you just coupled together because you put some prompts into ChatGPT and you said, hey, create for me the code for blah 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 blah, and you created it. Like, that's absolutely fine. The whole idea is that you're just testing things out. And that's where, like, from the go-to-market perspective, meaning how do you actually go about promoting and selling your product, there's no expectation. You should not have any ideas at this point about this, maybe some rough little indication, but really it's all about the prototype of your idea. And this is where, like, you can talk about friends and family, angel investors, or startup incubators. I didn't mention them when I was talking about different types of investment, but worth mentioning here. Startup incubators is essentially organizations that like to provide shared resources for different startups to go and experiment and play around with the idea. I've worked at one of the incubators back in the day, and the whole idea is really you should just have a space for them, almost like a co-working space sometimes, to get together. They have a shared resource. There may be someone like myself who is an operator and a finance guy. There's another person who's a marketing guy. There's another person who's maybe a product guy. And you just go around between these like small offices or small desks and spaces and talk to the founders. And usually the founding group is like 2 to 3 people at most. And you just like check in with them. Hey, how are you guys going? What's happening? What are you thinking about? And you criticize the idea. You give them some additional feedback and kind of like help nudge them in the right direction. So that's what incubators do. And sometimes they offer some additional investment services, but usually just more about the space and the shared resources. So those are usually the good places to be at when it comes to the pre-seed, because friends and family can help you maybe fund the prototype. If you want to, like, say you're making a physical product, you just want to order a few test samples, or you met an angel investor and they co-invest with you, right? Like, that's as complex as it gets. The whole idea is to confirm that you can actually create the product. Seed is now you start thinking about, okay, I have a product. I know I can potentially sell it. Let me go and actually try to market it. And this is where, from the revenue perspective, seed can be anywhere between like $0 still dollars to 2 million. Sometimes people still offer it for free. Maybe you, even if it's a physical product or a digital good, you still create it, but then you offer it for free because you just want to collect as much feedback as possible. So you just put it in the hands of people, observe them, write down the feedback, iterate, improve the product, put it back in their hands, going back and forth. And this is where, like, it's more like an alpha or beta launch. If you're not familiar, essentially the whole concept of alpha and beta launch is that you just put something out there and you continuously test, right? Alpha is a very early stage, beta is a little bit of a later stage, and then you kind of like slowly progress towards the full launch. But this is where, like, right now at that stage, at the seed, you just kind of like play around, you iterate, you improve your product, but you don't do too much necessarily with it. And then you have some early outlines of how you're going to sell it, because as you get the feedback, hopefully from your potential customers, you start learning, hey, how much would you pay for it? How would you pay for it? Oh, would you prefer to buy it online? Would you prefer to buy it in a store? Would you prefer it to be a subscription service? Now you start informing your idea about the go-to-market from the perspective of how would you market it, where would you put it, how would you sell it, things of that nature. And this is where angels become a little bit more important, because they potentially have the funding to help you support multiple different tests, multiple different iterations of your product, as well as maybe have some experience and some suggestions when it comes to, some early ideas about the go-to-market. And the VCs start popping up on this market. Usually in this case, probably VC will cut you like a 10, 20, $50,000 check. They're just trying to fill you out as an organization. They're placing a small bet on you. Then you're moving into the fun big boys game, Series A. So you'll hear about Series A, B, C, and we'll talk about all of them. But just think about Series A indicates the first time you kind of like take on a more serious investment, no pun intended. And then letter indicates is your first round, second round, third round, fourth round. I've seen companies going all the way to like stage F, Series F, which is kind of crazy, but it happens. And the idea is at this point, you kind of like, you went through all the tests, you're now making a little bit of money, you're, somewhere between like $2 to $5 million in revenue. You understand now how the product should function, and you really know how to sell it, or at least you're learning how to sell it. So you have emotion. It's no longer a prototype, it's no longer a test. Now you've done enough tests, you've conducted enough research, you understand who your customer is, and you're kind of like, go sell to them, sell more, see if you can service it, sell more if you can service it, sell more, and you continuously kind of like grow your revenue between that $2 to $5 million, right? And that's where you start defining a lot better your single persona who you're targeting, right? You're a cooking creator, you create cooking tools, is it a professional chef? Is it an amateur chef? It's somewhere in between. Who's your persona? Are they old? Are they young? Is it a man or a woman? Some other gender, like whatever they may be, right? Like you now starting kind of like to create that formation of the persona who is ideal customer for you. And you start to sell to them. And you also understand, do they prefer to shop online, in person? Do they prefer a subscription service, something else, right? So now you have a lot better defined structure around how you go to market. And this is where VCs are great, because VCs usually at this point will have enough of an appetite, because Series A is early enough where you can invest in the company, take a solid position in that company, meaning solid portion of their equity, and help them grow. So at this point, because you understand who you sell to, because you understand what the product is, it's much easier for you to translate and say, hey, VC, I'm going to take this $5 million investment from you for Series A, $10 million investment from you. And I'm going to spend $5 million of it on the product development, $2 million of it on hiring, and another $3 million on marketing, right? And you can kind of like break it down and outline it. Think back to some extent my video about Chamberlain Coffee and kind of like their presentation, although they're a little bit later stage. I think they're Series B or Series C at this point, but kind of like same rule apply. Now you understand what you're selling, who you're selling to, and what you need from the investment perspective to kind of like continue to grow it. So this is where VCs pretty much solely getting involved. Angels can still be somewhere part of it, but VCs are usually the ones that you'll be interacting more for your Series A round. And it can be multiple different VC companies combining their funds together to spread the risk between each other. And then we talk about Series B, and that's what I'm saying. From then on out, you start kind of like just like growing in revenue and the complexity of investment that you're structuring. So here you're probably somewhere between $5 to $20 million. I'm probably talking to like 1%, less than 1% of you out there who's going to get to that stage. Who knows? Maybe all of you will. Good on you, but it's very rare. It's much more complex to get your business to that level. And at this point, you have a pretty mature infrastructure when it comes to product. You understand what it takes to acquire new business, what it also takes to retain new business. Maybe you have slightly different services for either or. And you also have a very specific playbooks. You understand, okay, here's how I'm going to attract a new client. Here's how I'm going to retain the new client. Here's all the different playbooks I have. You probably have quite a few people working for you at this point. Company at the $20 million revenue, depending on how much you raised in prior rounds, you can have anywhere between like 20 to 100 plus people. So you have a more complex organization that can support all this kind of like steps. And this is where you might have a combination of more mature VCs, growth equity, companies that I mentioned earlier. Private equity will start getting involved because they might just see something interesting about you that might entice them to take a majority stake in your company. And you might also see corporate coming in here, because that's where they start spotting kind of like you as a potential, ankle biter, like, this product might challenge me in my niche. And they also have this creator attached to it who's great at developing the distribution for them. Let me keep an eye on them, and let me just invest a few $1 million so I can have an access to all this information. That's where whole probably separate topic about taking investment from the corporations, but there's some considerations when it comes to the money coming from the VC costs you less from the perspective of the ties than the private equity, which costs you a little bit more, than corporate, which will cost you a lot. So you really have to consider heavily the pros and cons of taking investment from the corporate. When it comes to whatever the stage you're functioning in, because it might be Trojan horse, for lack of a better word, that's seemingly a very good positive thing, but in reality, it might actually very negatively affect you. And a lot of corporations out there will say like, no, we never do that. It will be illegal, but grow up. People, it's a doggy dog's world out there, and they'll come after you if you build something interesting enough that might challenge their supremacy in a particular niche. So just be careful. And again, not to make it too like, scary. It'll be a good problem to have, and you'll have a lot more people like myself who experience in this, like helping you at that point. So you're not going to be alone making this decision at the business of $20 million plus in revenue. And then you kind of like enter the Series C plus, meaning like Series D, Series E, F, and so on and so forth. And at that point, as I said, you just grow more revenue. So your revenue grows more. Number of potential products that you're selling also grows, as well as sophistication of the different go-to-market motions will grow as well. And so at that point, again, you primarily VCs usually fall off because they don't like operating at that level. Private equity usually operates because they like to buy those companies out, kind of like grow them even further, help them go public, like a structured IPO, or again, try to sell them to a strategic. And that's where corporate might come in, because there might be potential strategic that comes in. So at that point, kind of like as you start hearing further stages, Series D, E, F, just think more money, higher valuation, more complexity around the organization. That's about it. So as I said, in reality, not that complex. I know I spoke probably a lot and I threw a bunch of terminology at you. But again, from the perspective of like, if I would summarize it without even showing again the visual in front of you, You have your pre-seed and seed where you're just early on trying to explore, figure out what the product is going to look like, who's going to be a customer, and how to sell to them. Then you kind of like enter this early stage kind of like, post seed, pre series A, where you kind of like know what the product is, know who you're selling to, and you now figure out and just get better at it. And then as you go further, now you're figuring out how to renew, how to sell more stuff, how to build new products, how to promote it. So it just becomes more complex at that point. That's it. And I suspect for a lot of the creator led businesses, Series A is probably where they're going to start kind of like, funneling out, because at that point, a lot of the creators who at least I know, who I've spoken with, majority of them don't want to build super complex companies. Usually they see creation of the companies, probably like yourself, as a way to diversify your revenue, potentially find an interesting exit, right? Because if you grow a Series A company, you have that like $5-10 million in revenue. If it's interesting enough of a company with interesting enough of a product in a popular niche, you might be able to sell that company for like $100 million, right? And depending on how much equity you retained, say even if it's only 50%, screw it, it's 30%. You're still gonna clear like $30 million probably after taxes and everything, like something like 20 or right under 20, high teens. That's good. You're retired at this point. You can comfortably retire and live the rest of your life and support probably your kids and your grandkids and go do your own angel investing at that point, right? So like Series A, where I expect a lot of the creators just like tapping out, selling their companies and moving on, and very few would go on and say, no, I want to raise more, I want to build a bigger company because I have aspiration of building multi-billion-dollar venture, which is awesome. Absolutely supporting it and would love to participate in those kind of like projects. But as I said, I usually expect that a lot of the creator companies will stop at about Series A. And yeah, that's in a nutshell the entire process. So as I said, from the investment perspective, it's not as complex as people make it seem. From the stages perspective, it's definitely not as complex as it seems. A lot of complexity really comes in as you start figuring out the products, the complexities around that, and the go-to-market, which requires some additional considerations as you become more mature. But as I said, at that point, hopefully you have a good problem to have because you have the revenue and you have the funding to support hiring folks like myself who've done it for like 10 plus, 15 plus years, 20 years, and we can go and help you, right? Again, you're not going to be on your own when those kinds of situations. That's why you raise the funds. You can do it on your own, great, keep doing it, and especially if you prefer to avoid any kind of complexity, stick to the friends and family. But if you're really trying to grow, trying to build a more complex business, you're going to raise funds, you're going to go down this chain, kind of like, so to speak, and you're going to get enough funds to hire folks like myself to go and actually, help you take it to the whole next level. So key takeaways from all of this that I wanted to like flash in front of you: really understand who you are and what you're trying to go after, right? The whole conversation here is that, as I mentioned, I expect majority of the creators say Series A is about where I stop, I sell the company, and I move on with my life and hopefully retire. If that's what you are, that's awesome. Just keep that in mind and focus on making the most of these early stages. Although, if you're trying to be kind of like that entrepreneur who's building multi-billion-dollar company, that is awesome as well. Just consider the fact that the complexity will increase, the type of people who you're dealing with will increase. You'll start working with private equity and all those other companies, so it can get more complex, but also actually a lot interesting. I enjoy those stages, so that's that part. And this kind of like flows into agree on where you want to be. So I work with a few startup founders who sold their companies, companies that I worked for, acquired them, and I asked them all. I was like, hey, what was the key benefit? Like, what was the key hack, like a secret way or something people don't talk about that help you make the most of this kind of like early stages and make it to where right now you came here and you sold the company to my company, or you did something else and you sold it to someone else? Like, what was that like one thing that people don't talk about enough? I kid you not, almost every single one of them said, decide early on what you're trying to do. Don't walk into the situation thinking you're going to sell the company that you're building as a creator, and then 3 years in, see the numbers keep going up, and you're like, oh, wow, maybe it's going to be $1 billion, $10 billion, $100 billion business. Like, oh, I want to stay, I want to do more. Don't do it. You're risking frustrating yourself mentally. You might not be prepared to handle, as I said, all those additional complexities. Early on, decide, like, what is your exit number? What is that number that's, if put in front of you, will be enough for you to say, I did good, my team did good, time to hand over the keys and let someone else take the wheel, right? Is it a $100 million business? and you own X portion of it, decide for yourself specifically. That way you can kind of like keep monitoring for the equity stakes and how much you might clear. So say for yourself, you decide that you need at least $20 million to live comfortably for the rest of your life. Cool. $10 million. Awesome. Five. That's absolutely fine. Whatever your lifestyle is, like you don't have to buy Lamborghinis every year, right? Be frugal. Whole other separate conversation. But decide what that number is, decide where you're going with it, and I promise you're going to have a much better experience, because people who you're going to partner with, you're going to openly tell them like, hey, we're not building the next Microsoft here. We're building a company that's going to be acquired by Microsoft in 3 years for $100+ million, and we're all going to be rich and we're all going to retire. Completely different conversation. Have it early on and make sure people are aligned. Maybe not junior folks in the company. That's, again, as I said, separate maybe topic, but it's not something you should be burdening them with. But when it comes to your key partners and equity stakeholders, including your investors, you should be very open. When you talk to the investors, you should tell them, hey, I'm raising the funds, I want to do this, and in 3 years, I want to sell this company. And that will ensure that the people who you partner with actually align with you on that goal. And then pick a path. And as I said, the partner to get you there. Make sure as you decide, like, hey, I really don't want to deal with any buyouts. I don't want to deal with anyone who tries to tell me how to manage my business. Private equity is probably not the type of investors you're going to attract. You should probably focus on those who's going to be less hands-on with your business, which means it's likely just going to be VC. Or you can say like, hey, actually, I would love someone to come in and teach me, and I want to be there. I want to learn from them, and I want to learn from their expertise. Private equity is a great then partner for you, right? Decide on this. It's, again, I like to use that metaphor a lot. It's like a marriage. It's like a partnership, right? Kinship that you have. How far you're going to go and how successful you will be is based on how open you are with each other about your goals and ensuring your partner is aligned with you on that path, right? And as I mentioned just earlier, if you want to sell this company, if you want to get it to a certain level and you're very transparent with them, you're going to attract the type of investors who are interested in the same thing. They're going to be on you, kind of like they will be supporting you on that path. And then when it's time to exit, if say you were very transparent with them, they'll know to be on the lookout, and they will even help you make sure that the exit is executed in the best way possible, because they're going to benefit from it as well. It's all about transparency, communication, and deciding early on what you want to do. And it's something, if you watch my prior videos, you know that I am a big fan of. Even as a creator, I always tell creators, like, decide early on who you want to be as a creator, right? And just check in with yourself every 6 to 12 months and make sure you're moving in that direction. As you start monetizing, keep checking in and decide like, hey, is this moving me in the right direction, wrong direction? Am I getting distracted? Same thing happens then in the business, because the business hopefully will be part of the journey. You'll decide like, hey, at some point I want to open the business. Okay, what does this business look like? Who is managing it? Are you running it on your own? Is it your forever kind of job that you want to just maintain until you're dead and pass it on to your kids? Or is it something like a short-term 5, 7, 10-year project? You go, you work on, you grow it to a certain level, you sell it, you retire. Decide on those things early on, what sounds attractive, plan it out. I have plenty of videos covering different stages, whether you're a creator, whether you're deciding on monetization. And now I have this series of videos talking about specific investment companies. And then kind of like go on that path, check back with yourself every 6 to 12 months and decide if you're moving in that direction. And if you're not, just course correct. So I hope this was useful. If, again, there's a lot of information. If you would like, comment in the section below if you have any questions, or just reach out. I'm always happy to chat about those things. As clearly you can tell, I love these topics. I'm coming from that space. I work in the VC, I work in the PE, I work on acquiring companies. So I kind of like talk to quite a few folks who started their companies and understand their mentality, as well as understand the mentality of larger corporations. And just in general, I think it's a fun thing. It's like people get excited about selling physical products, digital products. I get excited about selling companies. Just fun. So I hope this was useful. Let me know in the comment section below if you have any other questions. Reach out to me directly. Happy to chat with you about all of this and more. Check out the rest of the videos on this subject about how you structure the investments, how you model it out, how you tell your story. There's quite a few videos on this subject, especially that I've posted in the past couple of months. And yeah, I'm excited to see you next Saturday talking about some other interesting investment topic, or just in general about the business of being a creator. I'll see you next Saturday. Peace.